An attorney friend asked a question regarding the following scenario. Mark, I often have client situations where the parent is looking to lend money to their child to help with some major home improvement or issue. And the legal recommendation is to have them do a promissory note outlining the terms along with an unrecorded deed of trust as backup protection in case something goes wrong. If clients end up doing that and then the child wants to refinance the property to pay back the parent, are there any issues from a lender perspective, assuming the deed of trust stays unrecorded? Does recording the deed of trust cause any issues itself? Your thoughts most appreciated. Stephanie, if the deed of trust is unrecorded, then the lender is simply unaware. No big deal. When the customer goes to refinance, it's going to be considered cash out to pay back the parents, and they would need to adhere to cash out refinancing guidelines. Not a problem at all. If the deed of trust is recorded, that will simply make the lender aware, and when they go to refinance, it's still going to be treated as a cash out refinance and have to adhere to those guidelines. Here's where there may be an issue of it being recorded versus unrecorded, and it's going to be a matter of flexibility. Given cash out refinance guidelines restrict the loan to value that's available, I'd say that if there's a question on how much equity there is in the home, and let's say that the customer for some reason wanted to be able to get access to funds sooner than later, and maybe there's only enough equity to get a partial amount of those funds to give back to the parents. Well, if that deed of trust is recorded, then it's going to affect the loan to value guidelines, and we may not be able to pull out even those partial funds. In short, the deed of trust not being recorded is going to provide more flexibility. Here's a second situation. Let's say that the customer wants to refinance their first lien and that second is recorded. The guidelines in regards to loan to value may affect them from being able to refinance that first lien. Again, flexibility is the bonus of that deed of trust not being recorded. In general, here are the cash out guidelines. A 1-unit primary residence property would be limited to 80% loan to value. 2 to 4 unit primary residence homes would be limited to a 75% loan to value. Second homes and 1-unit investment properties are also limited to 75%. 2 to 4 unit investment properties are limited to a 70% loan to value. If you have questions you'd like me to answer, please email me at mark.teran@apmortgage.com. I'm always here to help you and those you care about.